What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. With the recent market crash and impending global recession, the biggest question on every investor's mind is when the stock market will finally turn around. As of the time of recording this video, the Dow Jones Industrial Average has fallen by 19%, the S&P 500 has fallen 25%, and the tech-heavy Nasdaq has fallen by a whopping 35%. Given the situation, it's very tempting to want to buy the dip. After all, Warren Buffett made tens of billions of dollars in profits by buying stocks at the trough of the 2009 bear market when everyone else was panicking. But if you've bought the dip at any point this year, you're likely regretting that decision, with markets continuing to decline day after day. So what should we do? At some point we will reach a bottom in the stock market, but how are we supposed to know when that is? A few days ago, the legendary hedge fund billionaire Ray Dalio gave an interview explaining his thoughts on the current market crash and his outlook for the future. In this video, we'll look at what Dalio had to say and how this can inform us going forward. This episode was brought to you by Incogni. Whenever you do anything online, there are hundreds of companies that collect your personal data without your knowledge. Data such as your name, email address, home address, and even your social security number. They sell this data to third parties to target advertising, adjust your credit score, and a whole host of other things. But what's really scary is that these data brokers can be hacked, and your personal data can end up in the hands of fraudsters and cybercriminals. For example, in 2020, a data broker called LimeLeads was hacked, and 49 million people had their personal data sold to all types of nefarious actors on the dark web. Imagine waking up one morning to see that your bank account has been emptied out, or that someone else fraudulently took a loan out in your name. It happens all the time. There are laws that allow you to remove your personal data from these brokers, but unless you're a lawyer, this is pretty much impractical for most people. Incogni handles this all for you. Just sign up for an account and they'll automatically find the data brokers that have your data and start the process of removing it. Within weeks, you can rest assured that nobody is profiting from your personal data and putting you at risk. So check out Incogni using the link below, or go to incogni.com/wallstreet. The first 100 people to use the code WallStreet will get 20% off. So get your personal data off the market with Incogni today. And now back to the video. Unsurprisingly, Dalio's main focus was inflation and the Federal Reserve's interest rate policies, as these are the two most pressing issues facing the markets today. Currently, the labor market is strong and unemployment is low. The only real economic problem we're facing is inflation running at about 8%, well above the Fed's target. The question is whether or not the Fed can engineer a so-called soft landing, whereby inflation decreases without causing a recession. If this is not the case, the rate hikes will likely cause a painful recession, with mass corporate bankruptcies and unemployment. Ray Dalio strongly holds the view that the latter is the more likely scenario.
We talk about inflation. Inflation is a very simple thing. It's the amount of money that's spent, money and credit spent, divided by the quantity sold is the price. And so if you take that money away, then you can't get rid of inflation. The way you get rid of inflation is to get people to spend less. And that is what an economic downturn.
Inflation happens when there is too much money chasing too few goods. When unemployment is low and wages are rising, people have more money to go out and shop. This allows companies to raise their prices. Companies will only stop raising prices when consumers can no longer afford to pay. And the only way to achieve this is for consumers to have less money. This necessarily entails a decline in nominal wages. According to the Bureau of Labor Statistics, there are currently 0.6 unemployed people per job opening in the US. That's a near record low, and a much lower ratio than in 2019 when the economy was also very strong. There are more job openings than available workers, so companies have to compete fiercely for employees. Workers have incredible bargaining power, which has in part led to the so-called Great Resignation, as many workers quit their low-paid and unfulfilling jobs. This has caused companies to offer wages that would have seemed unbelievable just 1 or 2 years ago. The point is, so long as unemployment is low, companies have no choice but to increase wages to retain their employees. That's why Ray Dalio says the idea of a soft landing is a farce. There is no way to decrease inflation without also increasing unemployment, i.e. a painful recession. The question is, how bad will the recession have to be? One thing that will make the current rate hiking cycle significantly more painful than the previous ones is the massive buildup of debt over the past decade. Both the government and the private sector alike have taken advantage of the artificially low interest rates that the Fed has created to borrow huge amounts of money. And this is not a recent phenomenon. Since peaking in the 1980s, interest rates in the US have been on a long-term decline. This decline accelerated after the Fed started its QE programs in 2008 and 2020. Unsurprisingly, the total level of debt in the US has been increasing consistently over the past 30 years as interest rates have fallen. Between the state and local government, the federal government, corporations, and households, there's about $68 trillion of total debt in the US, or more than 3 times of GDP. That has been great for corporate America and the American economy in general. Families can take out large home mortgages with relatively low monthly payments. And corporations can boost their share prices by buying back their own stock. As of 2017, 30% of corporate share repurchases were funded by debt. This number has likely increased since then as the interest rates continued to fall. And of course, governments controlled by both parties have borrowed trillions of dollars to fund tax cuts, COVID stimulus, infrastructure spending, etc. For the past decade, this massive debt binge has been funded indirectly by the Federal Reserve, which has continuously printed trillions of dollars to keep interest rates low. Now they're reversing course. Not only have they stopped their quantitative easing policies, they're doing the exact opposite. They're now starting to sell the trillions of dollars worth of bonds that they've accumulated over the past decade onto the open market. The question is, who is going to buy these bonds?
The government is going to borrow, central government is going to borrow about 5% of GDP, so they have to sell bonds in that amount. The Federal Reserve is going to sell, or have run off the balance sheet, about 5% of GDP. That's 10% of GDP. Okay, who's going to buy the bonds? Who's going to buy that? Oh, now they don't want to buy the bonds. We've had, pension funds, others, they don't want to buy that bonds. Foreigners don't want to buy the bonds. So then the way that works is interest rates have got to go up to a level that constricts private credit demand.
If the Fed isn't going to buy the bonds, interest rates necessarily have to increase to a level where pension funds and other investors are willing to buy them. For private sector investors to be willing to buy bonds, the interest rate has to be significantly greater than inflation. Getting a 4% yield on your bond holdings isn't going to cut it when the purchasing power of each dollar is decreasing at 8% per year. And that's what Dalio is the most concerned about. An interest rate high enough to attract private sector investors may be too high for the economy to handle.
We're going to have probably, I would estimate, maybe somewhere between a structural employment inflation rate, maybe in the vicinity of between 4 and 5%. In a highly uncertain environment, you can't even be sure of that, but let's say that. That means then what is the real bond yield? Okay, so you have to go to that. We now have about a 1.5% real bond yield. Do you still have a 1%? So you have to have the bond yield give you something. I don't know what that is, but that brings it above 4.5% to some other number. The economy could not take an interest rate much higher than that before it's going to be negative.
With $68 trillion of debt, every 1% increase in the interest rates will cause aggregate interest expense to increase by $680 billion. That won't happen immediately because the vast majority of debt in the US is fixed rate. But eventually, the debt will have to be refinanced at higher rates. Corporations that borrowed billions of dollars to finance share repurchases may be unable to service this higher interest expense and face bankruptcy. Also, the US government is on track to borrow about 5% of GDP this year to fund its budget deficit. The fact that they're borrowing such an obscene amount of money during a period of high inflation just shows how addicted the US has become to cheap money. This puts the Fed in a conundrum. If they're really serious about fighting inflation, they must force the economy into a deep recession and force the government to either massively cut back on spending or massively raise taxes. But given the 2-year election cycles Washington runs on, it's hard to imagine either party becoming fiscally responsible anytime soon. Given the economic and political realities that the Fed faces, Dalio says that they will have to find some middle ground between reducing inflation and avoiding an economic crisis.
And the way that happens is a mix of some amount of restructuring debts, and that is a deflationary force because one man's debts are another man's assets. And so some amount of restructuring is a deflationary force. You take buying power away from others. And then some form of debt monetization. and to get the stimulus, and they tried to get the middle ground.
Basically, the US economy has an unsustainable amount of debt. There are two ways to bring it down. The first is what Dalio calls restructuring. This is a fancy way of saying a negotiated bankruptcy, where creditors receive less than the face value of their bonds. The second way is monetization. This is a fancy way of saying that the Fed will bring back QE and inflate away the real value of the debt. The Fed will raise interest rates to a point where the weakest companies will go bankrupt. These will be the companies with the highest debt loads and the least profitability. However, once it gets to the point where the economy is in a deep recession and otherwise healthy companies would start to go bankrupt and the government is unable to fund its budget deficit, the Fed will start quantitative easing again. This is the monetization that Dalio was talking about. The Fed will not be willing to take inflation all the way down to its 2% target, as the economic consequences would be too painful. They will only go halfway, and inflation will settle somewhere near 5%. So what does this all mean for investors? What should you do when we're heading into at least a shallow recession, but inflation is still going to remain well above 2%? With inflation burning away your savings, what can you use as a storehold of wealth?
This is the question of our time. We will, over the next 10 years, certainly, I think, be trying to find the answer of what is the storehold of wealth, because usually it's a money and then a debt instrument in holding that money. But as that goes down, then there is the question of what it is. What is that currency and storehold of wealth? So we're in that place. It's always handy to be the thing that is your buying power. You're going to see it more in inflation hedge assets. So like if you're thinking about a bond, it's better to think about an inflation hedge bond than to think about a TIPS or inflation hedge assets along those lines.
He suggests buying assets that protect you from inflation. The US Treasury sells two types of bonds: nominal bonds that pay you a fixed yield, and inflation index bonds called TIPS that pay you some interest rate plus inflation. If we take the difference in yields between the nominal bonds and the inflation indexed bonds, we get the market's expectations for future inflation. As of October 13th, the market's expectation of average inflation over the next 5 years is about 2.5%. If Ray Dalio is right, the market is currently underestimating future inflation. If we assume that inflation averages 5% for the foreseeable future, which is what Dalio predicts, TIPS bonds will give you a nominal yield of about 6.5%, compared to about 4% for non-inflation protected bonds. The easiest way to buy TIPS bonds is through ETFs like the STIP iShares ETF, which holds short-duration inflation index bonds, or the LPTZ, which holds long-dated inflation index bonds. They both have real yields of about 2%. They have declined substantially over the past few months as real yields have risen. But if you hold them until maturity, you'll make a total return of 2% greater than inflation. Holding TIPS is the only way to protect your wealth from inflation with 100% certainty. The problem is, you're locking in a 2% real return, which is not great. The second way to protect your wealth from inflation is to buy stocks. Stocks represent stakes in companies whose revenue and profits should increase in line with inflation. Of course, this is far more risky. The Nasdaq 100 is down 35% year to date in anticipation of the Fed creating a recession, which will crush corporate earnings. If Dalio is right, the Fed is going to make a trade-off between inflation and economic pain, such that the recession will only be shallow. Unemployment will rise and corporate earnings will fall, but the Fed will reverse course and start printing money again before it gets too painful. Currently, the price-to-earnings ratio of the S&P 600 Small Cap Index is 11. This is a similar level to where it was trading at the trough of the COVID crash in March of 2020, as well as the financial crisis in 2008. The market is already pricing in a very severe recession, so it might finally be the time to start buying the dip. Alright guys, that wraps it up for this video. What do you think about Ray Dalio's predictions? Do you agree or disagree that inflation index bonds are superior to nominal bonds? Do you think the stock market has finally hit a bottom? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.